Hey guys, so this is going to be the first video of a new series I'm starting where I highlight dividend stocks and ETFs that I feel like are going to be really attractive to low budget investors like myself. See, when I first started investing over 5 years ago, one thing that really concerned me and almost held me back is the feeling that the little money that I had wouldn't make much of a difference in the long term, the next 10 to 20 years. But the truth is there are plenty of dividend stocks and ETFs out there that have some really strong, long potential growth when it comes to their share price and dividends, no matter how much money you put into them. So with that being said, in this first episode of what I'm going to call Diamond Dividends, we'll see how long that lasts, I'm going to highlight one of, if not the most popular exchange traded fund out in the market right now for dividend investors, and how it's a bit more accessible after its 3-to-1 stock split. SCHD, or the Schwab US Dividend Equity ETF, monitors stocks within the Dow Jones Index that follow these particular requirements. First off, they each have to have at least 10 years of consistent dividend payouts. They have to have a minimum float adjusted market cap of $500 million, which is based off the shares available for public trading, and a minimum daily value trading of $2 million. That's the average number of shares traded in a day. With all that being said, they roughly have about 100 shares that they monitor, and even the breakdown of those shares have to follow a specific requirement when it comes to the entire ETF. The individual stocks can't make up more than 4% of the index, and sectors can't make up more than 25%. Now, speaking of the holdings, you'll notice that a lot of these positions that SCHD monitors, especially for the sake of this video, the top 10, has some similar characteristics, especially when it comes to their dividend compound annual growth rate and their share price growth for the most part. Side note, dividend compound annual growth rate is just a percentage of growth that the dividend yield would have to take to reach from where it is at that point to at some period of time from that point. In this case, we're going to go off 5 years. From its top 10, number 1 is Pfizer with a 6.56% dividend yield. It has 14 years of growth and 35 years of consistent payouts, and it has a 5-year CAGR of 4.25%. Now, on the downside, it does have a 10-year share price growth of negative 19%. Next is AbbVie with a 3.77% dividend yield and 11 years of consistent dividend growth and payouts with a 7.46% 5-year CAGR, and it does have a 10-year share price growth of 174%. Then you have Coca-Cola with a 3.13% yield with 62 years of dividend growth, making it a dividend king, and it has a 5-year CAGR of 3.93% with a 10-year share price growth of 44%. Next, you have Cisco Systems with a 2.7% yield, 13 years of consistent dividend growth, and a 2.71% 5-year compound annual growth rate, a little bit on the low end, but it does have a 10-year share price growth of 112.87%. Next, you have Chevron with a 4.16% dividend yield and 37 years of dividend growth with a 6.49% 5-year CAGR and a 47.9, almost 48% 10-year share price growth. After that, you have Texas Instrument with a 2.81% yield and 19 years of dividend growth with 35 consistent years of payouts and a 10.38% 5-year CAGR with a 261.19% 10-year share price growth. That's currently the highest out of its top 10, so good thing to keep in mind. After that, you have Amgen with a 3.5% dividend yield and 13 years of dividend growth, over 9% 5-year CAGR and a 69% 10-year share price growth. Then Bristol Myers with a 4.45% dividend yield, 8 years of dividend growth, but 35 years of consistent payouts, 7.57% CAGR, and a negative 11% 10-year share price growth. Then you have Lockheed Martin at 2.72% yield with 22 years of dividend growth and 29 years of consistent payouts with a 5-year CAGR of 7.21% and a 10-year share price growth of 144%. But last but not least, you have BlackRock with a 2.12% dividend yield, 15 years of dividend growth, 9% 5-year CAGR, and a 10-year share price growth of 180%, so not bad. So for me, the biggest thing that I can highlight from this top 10 is that the tech sector doesn't really make up much of this ETF. It currently makes up only about 10.59%, which really explains the volatility, and I'll get a little into that in a little bit. But also you see a few of these companies have a negative share price growth over the past 10 years, so that makes me really excited on what they do in their next reconstitution. Side note, every year, once a year, SCHD goes through what's called a reconstitution, which is essentially review all the positions that they monitor, make sure they're all following the same guidelines that are required for SCHD, and if they're not, they remove them and replace them with whatever they feel like is. But with that, you can see how all these positions help with SCHD and their financial details as a whole. At the making of this video at least, SCHD is currently at about $28 a share, and that's of course after their 3-to-1 share split that they did back in October, which was a super surprise for a lot of us. They have a 3.57% dividend yield. They actually have a 5-year dividend average of 3.3%, so growth is great. They have 13 years of consistent dividend growth, and for the past 3 to 5 to 10 years, their dividend CAGR sits at 9.87%, 11.59%, and 11.04%. So definitely not bad at all. On top of that, they have a share price growth history of 10% over the past year, 41% over the past 5 years, and a little over 100% in the past 10 years. So that consistent growth in dividend CAGR and their share price growth is something that a lot of us would benefit from, especially when you're not investing much. Speaking of being more attractive to low budget investors, I mentioned earlier how it only has a 10.5% sector within technology and how that could minimize volatility. Well, it actually has a beta of 0.77, and that's in relation to the S&P 500. If you have a beta of 1, that means that position is just as volatile as the S&P 500. Anything higher, it's more volatile. Anything lower, it's less volatile. So 0.77, less volatile. It also has a 0.06% expense ratio. These are fees charged for using the fund's services. And since they only do reconstitutions or modifications once every year, and they do slight percentage changes on what's currently there once every quarter, this is a very passive position, which is why they don't charge as much in the expense ratio. The charge is so little that for every $10,000 that you actually put into SCHD, if I do my math right, that's only $6 you're being charged every single year. Probably something you're not going to really think about when it comes to all that growth. Now, realistic examples, in my opinion, can definitely increase the level of motivation that a lot of us may need to take the little money that we can budget to invest into the stock market for the long term. So since I'm really avid about speaking out about only investing $30 per week, which is not a lot compared to a lot of other people on this platform, that's okay. I always want to keep in mind what this could potentially turn into based on the positions past if I invest, for example, $30 a week into SCHD for the long term. So if I assume an 11% annual dividend growth, $30 per week invested, or $15.60 per year, and 10% annual share price growth, within the next 5 years, I would make $10,147 in unrealized profit, and I'd make about $358 per year in dividends. 10 years from that point, I would make $29,414 in unrealized profit, and a little over $1,000, almost $1,100 per year in dividends. And in 15 years from now, I'd be looking at a little over $66,000 and $2,569 per year in dividends. So with that and everything I said, I personally believe that SCHD is an absolute beast when it comes to long-term growth and long-term dividend growth, especially for low budget investors. Not only that, but it does give you a variety of positions to invest into while touching a little bit in the tech sector, but not too much, so you're avoiding a little of that volatility if that's something that concerns you when investing for the long term. But of course, let me know in the comments below what you think about SCHD when it comes to low budget investing, and if there are any other positions that actually ring a bell when talking about SCHD, and let me know what you think about this series altogether. It'd be great to hear from you guys. But I appreciate you guys taking the time to watch this video as always. And until next time, take care.